Hello everyone, welcome to the newsletter for February 14th. We're going to be going through my new toy at the moment, which is the Glassnode dashboard. So as some of you know, I've joined the team at Glassnode, so more or less what my role is essentially whatever I want it to be, which is a really exciting opportunity, but my general direction is to obviously get more people onto their platform, and I think the best way to do that is essentially what we've been talking about for a long time, which is discovering the edge that on-chain can actually provide you. So what I want to go through today is that a dashboard that I've put together. I mean, I'll talk through a number of these different tools, but it's essentially what I'm going to be trying to do for Glassnode is to show people how you can actually use these tools, bring it more into front and center, and help people understand that there really is a huge amount of edge when you understand it, and it's not that scary. And a lot of people think you need code and Python and all sorts of other, mathematical wizardry. The reality is that all you need to do is understand, what we've been talking about, which is the psychology of all the people who are trading this thing. Starting to understand a little bit about all the different dynamics of whether it's miners, whether it's old hands that are selling into strength. So just to kind of set the stage, what we're looking at today, there's essentially a prevailing narrative at the moment of institutions coming into Bitcoin and essentially entering in size, right? We're talking about tens of thousands of Bitcoin. Let's classify a whale as someone who's got more than 1,000 BTC, right? So at current prices, that's talking about 40 million plus. So we're in the tens of millions of dollar range. This is the high net worth individual kind of scope. Some of them will be between 100 and 1,000, but really we're talking about 1,000 plus BTC holdings. And they're relatively new buyers, right? They've found the confidence now that Bitcoin has broken all-time high. We're really starting to get into that narrative momentum of a number of different corporations stepping in. And obviously price is going to rise if there isn't enough coin supply to meet that current demand, right? Now, as price rises, obviously someone who's then buying with the same Elon Musk 1.5 billion, if price is 2 times the size, they're getting 2 times fewer coins, right? Half the coins. So the question comes in, who is selling to these whales? So, in my general view, there's going to be 2 natural sellers to all of this. And we're going to talk through this dashboard is kind of structured to look at this workflow, but just to give you a bit of an insight into where we're going with all of this. There's obviously miners who are going to be natural sellers. They're naturally going to want to be liquidating some of their stash. They've got their cost basis in energy, but there's some really interesting charts that we'll look at in terms of what miners have been up to just add a bit of flavor to that. But the other one, which I think is probably the dominant seller in all of this, and most likely the people that you actually want to be paying attention to, are essentially the old money. Now, there's going to be a few different versions of old money. There's going to be people who bought Bitcoin way back, right? We're talking about pre-2017, pre-2016. I would almost say 2016 and before are people who are buying in the hundreds of dollars and they're now selling at the tens of thousands of dollar range. So there's obviously a significant amount of profit built up in their coin supplies, and a lot of coin days, right? The dormancy, how long those coins have been in cold storage. And the other thing that's important is the narrative is starting to shift. So, we're moving into this more institutional type realm. There's going to be more and more people who bought into the cypherpunk ethos who are very much going to be put off by that, right? That's not exactly what they're there for. They're seeing the narrative and the direction of the project change. They're also seeing exorbitant profits on the table. It is very probable that we're going to get a lot of these people who essentially take this as their exit, right? So we're going to get old coins that transfer that wealth to institutions. They take their payday and live very happily for the rest of their life. Yes, they may not have got the society or the end result. I mean, who knows? Maybe Bitcoin will get there, but this is one part of that narrative. Some of them will be saying this is not quite for me anymore, so they're going to be taking that exit and moving on from that front. So. Anyway, let's get into it. That's the kind of framework. We're looking at institutions coming in. We're then looking at who the natural sellers are and just trying to understand what those dynamics really look like. So let's take a bit of a look. So it's important. So we're in here in dashboards. There's 3 different major features for Glassnode. One is charts, which is obviously the big list of all the different charts. And obviously in different pricing tiers, you get different levels of access. The other one is dashboards, which you can actually build up, and this is one that I've essentially custom built. It's very simple. You just hit add metric. Yeah, you can basically pick from any asset that you want. You can pick any suite of these things. So ultimately, the skill comes down to knowing which one you actually want to put in there. And then there's compare, which I only found recently, where you can overlay 4 different plots. So you could look at, for example, token price versus tokens in smart contracts, or versus miner balance or exchange balance, or whatever you want. So you can do 4 different metrics, and it's all fairly robust. But we're going to be looking at this dashboard at the moment. I've called this whale watching because this is essentially what I'm trying to do. So at the top here, we've got a number of balances greater than 100 BTC, 1,000, 10,000, and then what we're calling total balances in accumulation, right? So you'll see that these different things have different metrics. So T2 is basically their lowest tier pricing, and it's about $25 or something a month. And the idea is that with T2, you get most of the data that's on Glassnode, and once you jump to tier 3, which is really for the professionals, the hedge funds, analysts, things like that, that's where you start looking at some very, very specific metrics and what they call entity adjusted. So they've got a team of guys who full-time track behavior on chain at the micro level. A lot of what you've seen me do, in fact, all of what you've seen me do, is essentially what I would call aggregate or market level, looking at all of the transaction, all of the volume, and pulling together information about the aggregate movement. What these guys do is they go down to the micro level and they look at how does Binance actually treat their exchange wallets. And then what they can do is they can look at all of these addresses and say, okay, yes, there's 10,000 transactions, but they're all Binance. So they entity adjust it. They bring it down and say, well, that's actually one economic entity. So that's what the tier 3 mostly gives you, is this kind of next level of, it's implying a lot of the micro level work that does require full-time work to maintain. It allows them to essentially instill that data and those heuristics into their T2 metrics. So it's kind of like a step up, but for the most part, you can get pretty much everything you need from the T2 level metrics. But obviously, you guys are insiders because you've got me on board, so we'll run through all of these where I've got access to the whole suite. So we're looking at the number of balances. We're looking at over a 2-year period. So we're pretty much talking about 2019 to today, which, again, you can swap all these things around, but this is a reasonable view. Now, interestingly here, you can see that the addresses that are greater than 100, they most certainly have been in an uptrend, at least on a local level. They were in a bit of a downtrend through 2019, but certainly back into an uptrend. And a reasonably strong one, essentially, since we had that breakup of us. We had the COVID sell-off. A few people obviously got spooked. And then we really started accumulating as we approached the all-time high back at 20,000. So overall, this is relatively good as an accumulation signal on the bigger time frame. You can see there's been a little bit of a pullback since we've got here to 40,000. I mean, realistically, I think that will probably end up breaking higher because 100 BTC is kind of the, small family office, high net worth individual. But, overall, what we've got here is essentially about a year-long uptrend, which is relatively positive, and I do expect that to resume. Short term, maybe a little bit of weakness. Very, very similar story, and in fact, even more. I mean, this is just a straight uptrend on the 1,000. So this is high net worth individuals and some institutions and funds, right, between about 1,000 BTC. Back here, obviously, when it was 8,000, 10,000, that's a smaller sum, but you can really see once we broke all-time high that really started going higher. So there is absolutely credence to the story that we've got institutions accumulating, and they are accumulating in some relative size. Again, a little bit of weakness here following the Elon candle. So a narrative that we're going to go through today is post-Elon candle. I'm kind of in the camp where I think we're going to get a little bit of chop and consolidation. There's a number of these metrics that are starting to really curl over. So this is one indication here, right? So we have a slight pullback since the Elon candle for 1,000 BTC addresses starting to sell off a little bit. Now, the addresses with 10,000 BTC, now you have to remember here, the scale here we're talking about is tens of thousands of addresses, or 16,000, 2,000 addresses on the 1,000, and on the 10,000, we're talking about less than 100 entities right now. So this would really encompass a lot of exchanges, MicroStrategy, custodians. We're talking about very, very few actors, but you can see that there is a little bit of an uptrend here, basically since the bottom at 29K. We're not really getting as much. I mean, if this thing was to break higher and keep going, then yeah, we're starting to talk about some serious accumulation. But there's also going to be consolidation. So there's going to be a shrinking number of custodians that are trusted. Coinbase is clearly where MicroStrategy is going. A number of different institutions are going to Coinbase. they're going to be doing their own clustering and things. So you may not get as much signal out of this 10,000 address type balance, but I think more relevant is to show you the magnitude of how many addresses actually hold that level of coin. And again, there will be some OGs, right? Some of this will be sell pressure coming from the OGs who mine 10,000 coins back, way back. But another one, so this is a T3 metric, is the total balances in accumulation. Now, very similar to our 1000 balance address, this is basically entity adjusted, where a coin's going into cold storage, pretty obvious trend, right? And post Elon candle, pretty obvious trend. So long term, still looking pretty bullish, little bit of weakness. We have to see how this plays out, but obviously the trend is most definitely in our favor. Number of entities, yeah. So this is now looking at, think about number of addresses, but essentially nailing it down to say how many of those are actually important metrics, right? How many of those are economic actors that are significant? And again, we've got a fairly significant trend, and particularly since all-time high. So this really is proof in the pudding that there are institutions coming in. They are distinct entities, so they are important. And again, we've got this accumulation in addresses that's a distinct uptrend. Now, what is interesting, if we look at the realized cap hodl wave, so this is looking at what percentage of supply is a certain age. Hot colors are essentially new UTXOs, and cooler colors are old UTXOs. So when we see spikes in the heat, right, in the hot colors starting to come up, it means that a bunch of old coins essentially came onto the market, right? So they converted from being old coins to being new coins. Now, you can see this lime green patch, right, which is the 2 to 3 year zone. You can see that started to squeeze in particularly. So 2 to 3 years ago, we're talking about 2018 to 2019. That's the kind of realm of accumulation. So this is telling me that there has been an upsurge in some of these younger coins. And what it's really telling me is that some of those old hands have actually sold into strength. So probably some of the funds, the hedge funds who accumulated back in 2018, $6,000, maybe even $3,000, $4,000 coin, they're essentially starting to take a little bit of profit up here at 40,000. But the other thing that's important to note is that we've got this this orange patch here, which is essentially our 1 to 3 month, and that's actually growing, and it's eating into the space of this slightly less 1 week to 1 month. So what that's actually saying is that there's been accumulation, and those coins are starting to mature. So this is starting to tell a bit of that narrative of some of the older hands. Now they're not necessarily OG whales, but obviously some of them will be. But we're talking about people who are buying in 2018, 2019, which for most of you listening is our time, right? That's when we probably entered the market. People who are accumulating in size there are taking a little bit of profit here, but simultaneously the people that they're selling to, their coins are starting to mature. So then they're not selling into this rally. So this is that transition, right? That transition of wealth, the changing of the guard over time. That's kind of what we're starting to see. Now, again, we've got to see how this data plays out, because really we're talking about since January that we've had this institutional inflow in true earnest. So, we're starting to see this narrative play out, and, we'll be watching this data to kind of see how that absorbs over time. If we were to just zoom in for the last 3 months, you can see that there's a little bit of an uptick again here in this hot color, which is, essentially, and these are, you can see that this wide orange patch, so this is the 1 week to 1 month. The bottom one is the 1 day to 1 week. So you can see that there's been a few coins that were last moved, right? This is about the Elon candle here on February 8th. You can see that we got an increase in those 1 week coins, right? Fairly recent coins, and it more or less ate into our 1 month coins. So we're talking about a lot of coins that are kind of removing, right? They've been purchased during the consolidation. They're then removing during the Elon candle. Maybe they're putting them in cold storage. Maybe they're, actually selling some, taking profit. Maybe there's a bit of nervousness. So, again, it's a fairly young signal at this point in time, but perhaps correlates with some of these small dips that we're seeing in our 1000s, our 100s, right? Our accumulation addresses. There could be some people who are they've seen this Elon pump and they're thinking maybe it's a little bit of a bubble, right? Now, if we look at 2 other metrics, so these are obviously important. On the left here, we've got exchange balances. You can see, let's go to our 2-year view. You can see that pretty much since the COVID crash or just before, we've been in a very, very impressive downtrend. Normally, it just doesn't go like this. This is very, very unique. It's been in fact, as of the 11th of February, across the 12-month mark, this all-time high watermark for exchange balances. Since the all-time high and today, about 600, number of the devil, 666,000 BTC have been removed from exchanges, right? And we're talking about that from about 3 million or just over 3 million. So it's about a 25% drawdown or a 20-something% drawdown in total BTC and exchanges. You can see we're not seeing a huge reversal of this thing. It's gone a little bit flat, so there's a little bit of tentative nature going on, but we're not seeing it just coins just flood into exchange. So right now it doesn't look to me like liquidation season, but it does look a little bit like maybe there's a bit of sensitivity in the market. Now let's look at our miner balance. So miners have actually been accumulating. So in an uptrend here, miners have been accumulating since 2019. And I'll show you a chart momentarily that describes this even better. So we've had miners actually accumulating coins. Now, a lot of this is going to be because, particularly post-COVID, it's going to be because the ASIC chips. Sorry, let me just step back 1 second. My view is that the plus token Ponzi, if you all remember when we went to 14,000, everyone was going, oh shit, that happened really quick. We are back in the money. Bitcoin is coming back and we're essentially underweight, right? I think most of you, if you were there for that, will remember that feeling. I think miners recognize that and essentially go, all right, we're probably going to go to, they're the smartest, most bullish in the space. So I think that was their trigger point to say, right, we could be heading back for all-time high. So the miners essentially started accumulating from that point on. They stopped selling as much. And since COVID, we know there's been ASIC supply chips that have been essentially constrained. Now, this doesn't even just apply across ASICs. This applies across all chips, right? Whether it's Samsung or, basically all chips have been very, very constrained since COVID. I'm not sure the full dynamics of it, but I do know that that is the case. So essentially, difficulty's been going sideways. So what that means is that coin price goes up, miners' costs are essentially remaining exactly the same because there's basically no competition because there's no new chips coming on to offset the new cost. So they're mining the same amount of coins, post-halving obviously, mining the same amount of coins for more profit. And that means that they can sell less of it so they can grow their treasury balance. Now, we saw a fairly substantial profit take basically as we broke all-time high. And I'll show you some charts with a little bit more detail to describe this momentarily. But you can see that they've actually started reaccumulating again, right? So this is a generally positive sign that we've got miners who actually, they've been pretty bullish. They do have a fair backlog, but again, we're talking about, 1.8 million coins, right? That they've got currently in their balance. They liquidated over this period of time, what's that, around 20,000 or 30,000 coins. So they didn't liquidate their whole balance, but they've certainly got a fairly substantial stack that they've been accumulating, which is, it is fairly impressive. Now, one thing to bear in mind actually is that the vast majority of this 1.8 million, so let's put some nuance to this, is actually Satoshi's coins. So let's jump across to another chart, which is not here. Hang on 1 second. Okay, so what we're looking at here is essentially the stacked chart of all different miners' balances, essentially. So down here in the yellow is who we assume to be the Satoshi miner, right? Named Patoshi. We have this Patoshi miner, and you can see obviously there's their mined coins, and then it's gone flatline. Now, this blue section here are miners that we don't really have a tag for. So we've got some of the big mining pools and the big mining groups, but you can see that relative to Patoshi, and call this other or unknown, we've got a huge discrepancy between modern miners, how much they actually have, and those two balances. So when we go back and look at our mining balance, remember that 1.8 million is largely dominated by Satoshi, who's got, let's say 1 million coins or just over 1 million coins, 1.1, and essentially other, right, which is unknown at this point in time. So let's turn off Satoshi and let's turn off other. So we'll come back and look at other in a moment, because my question was how much of that is OG miners. But anyway, let's start with our modern miners. You can see this trend of accumulation of the balance, right? So miners have essentially accumulated. Now you can see the axis here, how much smaller we are. We're talking about 40,000 or just shy of 45,000 at the peak. You can see that those miners have essentially been accumulating right through that particular zone. So you can see that we haven't seen levels of miner balance like this since 2014, right? Late 2014 in the previous bear market. And they've essentially liquidated ever since, which is obviously because of competition and upgrades and all the rest of it. But you can also see that we've got a changing of the guard, right? A lot of these old miners, we've got oranges and greens and reds and whatever else. Now we've transitioned to this green, this purple, this green, this blue, this green. So we've got about 5 major mining pools that are really dominating the exchange balance at this point in time, excluding the other portion. Now, let's look at the other portion. So this is the taking that other section, and one of the data scientists was looking at what happens if we partition it out by when the miner first showed up, right? So these dark blue are the 2009 miners. This is their balance. 2010, this is their balance. So you can see these different zones, and you can see who was actually selling at any particular time. So basically, they had a huge mining phase. This would have been the first halving somewhere in here, 2012. Then you get this basically selling off. ASICs start to come online around 2012. This actually would have been the first ASICs, because you get, this is basically the first winner, right? So they start accumulating, difficulties going up, and then competition really starts to come in, and they basically move into the free market world that we know. Now, that big sell-off that we saw, right? That previous sell-off that we were looking at, that's actually whoever this miner is here, this 2020, 2021, or 2019, relatively late to the game. And you can see that this is actually a 30,000, right? This is a $30,000 chunk that they sold into. So let's go to this guy here. You can actually see that these are relatively new miners, potentially this 2019 guy who's popped up. He was the one who actually sold into this rally coming off all-time high. So that gives you a bit of perspective on who the actual miners are who are actually selling into this particular strength. So that describes this sell-off here. It's basically one miner who's taking advantage of the strength and liquidating about 30,000 BTC, probably some kind of OTC type deal. So that's essentially outlaid our case for, yes, we definitely have institutions. In the very, very short term, over the past week, there's a little bit of a pause in accumulation activity. So now what we want to understand is, where could other sell pressure come in if it was to come in? And really, that's coming from the OG whales, right? We're talking about people who have huge amounts of dormant coins, stuff that they bought many, many years ago. And we'll be able to see that essentially by using time as our metric, right? The older a coin is, the more probable it is that it's held by a large entity. So what we're going to be looking at here is coin days destroyed, right? So coin days destroyed with an entity adjustment. So a coin day, if you buy one BTC, which is hard to do these days, but if you buy one BTC and you put it in storage, cold storage, and it doesn't move for 24 hours, it's accumulated one coin day, right? If you put 2 BTC into a wallet and hold it there for 2 days, you've got 2 BTC times 2 days, 4 coin days. So what coin days destroyed tells us is how many of those coin days, right, were destroyed on that particular day. It looks at all of the coins that moved. It looks at all of the, essentially the time that was built up, how old they were, multiplied by the coin itself. And it looks at how much of that was spent on a particular day. So the higher that the coin days destroyed value is, the more old coins moved. Yeah, because you've got a very, very large coin days destroyed. That means that someone moved a whole lot of coins, maybe one coin that's ancient, right? Satoshi era. If he moves a 50 BTC balance, it's not many coins on a relative basis, but they've got thousands of days accumulated. Or it could be someone who's moving, 50,000 BTC and they've got 6 coin days. They've been dormant for 6 days, right? So that's the balance we're looking at. And we're really looking for what is the actual trend of this thing relative to where we are in the market. So if we look over the last 2-year time frame, you can see you kind of get this relatively consistent baseline, right? It's not really doing that much exciting, but you can see that we really started to get this uptrend, particularly as we came up towards all-time high. And we've essentially, up to this 40,000 point, we're getting more and more old hands selling into strength. So there's a little bit of a trend up here where you've got older hands essentially liquidating into that strength. After we got the consolidation, now we'll talk about the SOPR, the spent output profit ratio. It's correlated to this. So you can see that once we got to this peak, during the consolidation, we essentially got a reset back down to our baseline level. Now, what that means is that fewer old coins were selling. So let's think about this in terms of trend. We start to approach all-time high, right? Some of the older coins start getting ready to sell into strength. Then we get a break of all-time high and a serious rally. And during that rally, old coins are going sell, 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 sell. Now, obviously, that sell pressure that's not insignificant. That's what essentially puts the top in, right? You've got supply overwhelming demand. And you can see some spikes where there's obviously some fairly significantly old coins that were coming into it. After the peak, the smart money goes, yeah, you know what? This is actually not the ultimate top. it's more likely we're going to keep going, but this is a consolidation. We're going to sit tight. So they sell less and less and less. The coin days go down because it's more new traders coming in, moving coins between exchanges, speculating, buying, realizing they're wrong, selling, all that kind of stuff. You get a lot more young coins moving around and less of them. We then get the Elon candle kick in, and that's when you get a whole lot more coin days destroyed kick in. So that's essentially, what this is telling me is the Elon candle here, and then again, we're getting a slight uptick recently, is telling me that OGs are still probably, they're not convinced that we deserve 40,000 yet. Maybe that's my kind of read. I think they are looking at the charts and they're going, you know what, we've had a pretty good rally. There's still strength. There's buyers coming in. I've got a lot of coins I need to move. I'm willing to take some profit right now. I think that's probably the best description. They're taking profit, and rightfully so. Some of these guys would have accumulated at very, very cheap prices. If we look at dormancy, so dormancy is very similar to coin days destroyed, but it accounts for, it's basically the average number of coin days destroyed per coin, right? So it adjusts for how many coins we're moving. So coin days destroyed kind of has baked into it a level of how many coins times how many days. Dormancy is then trying to adjust for the amount of coins that we're moving on that particular day. And you can see here, I've got a 7-day moving average on this. And you can see a very similar trend. So we've got increasing dormancy, essentially means that you've got more old coins moving, right? Very similar to coin days destroyed, but you can see that we get a little bit more signal coming out of this, right? You get a little bit more of this trending base going on. And you can see that we really did get that spike in dormancy. Now dormancy is kind of the inverse, right? So we've got more coin days being destroyed per coin during this initial rally past all-time high. Or approaching all-time high. It pretty much rallied the whole way up. The consolidation was in a calmer period, less coins being sold, and now that we've got our Elon candle, some of these coins are starting to come back into a move, and you can see this is actually, on a technical basis, this is technically moving back into an uptrend. So my general view from this is that yes, old hands are probably putting in a little bit of a top at this point in time. That's my general view. If we look at entity adjusted dormancy flow, right? There's a bit of a mouthful, and part of my job will be to actually shrink down this technical lingo. Hang on, this guy here. So entity adjusted dormancy flow. The best way to think about this, you're all familiar with the MVRV ratio or the Mayer multiple. This is essentially the MVRV equivalent for coin days destroyed. Yep. So this takes market cap and all sorts of other valuation as part of coin days destroyed. It's essentially the MVRV oscillator that accounts for coin days destroyed. So here we're looking at the full history, and you can see a very, very similar pattern to what we've seen before, right? You have this capitulation event. It then rallies up. So you basically get this very much an oscillatory behavior. But what we really care about is what does a bull market look like? So we get this initial uptrend. This ratio here, this is kind of the bull bear line where we start talking about, I would almost argue the middle of the bull, where we start to move into the topping type behavior. And you can see here that we've got our undervaluation zone, which we've obviously touched on every single one of these key elements, right? Even the COVID sell-off. Our tops are up here around, 4 million. You can see that our bull market essentially exists primarily above, right, this ratio of 1 million, and our bear market essentially exists below that. We got an initial rally up, so this actually tells us that we were still in a bear market, even though we rallied to 14,000, right? So because it essentially bounced off all of those levels, it was a sell the rally type event, right? Technically, this was a lower high relative to this guy, but it kind of woke the market up. And we got that initial dip back down, and here we are retesting this bull bear line, right? So this kind of feeds into, are we in the middle of the bull, right? Are we essentially about to transition from sensible, sane, relevant bull market where signals matter? Are we about to move into the parabolic phase where we get just euphoric and crazy? So you can see that this whole process, right, it's a bit of a topping signal, right? So the bull market is essentially an oscillation above this bull line, and then we get a very convincing breakdown below into the bear. Similar, obviously, this one was a fairly young system, but here very similar, right? You get this oscillation going on above the bull bear line, and then we dump down below it with some gusto. Now, as we come up to try and break through this level, you can see that we do encounter a little bit of resistance. We encountered resistance obviously here. We've tagged it once, right? We're coming up to tag it again. if we manage to get up above it, I mean, who knows, this thing could just keep going. But this kind of gives you a bit of a map or a bit of a radar based on where OGs are actually selling, where we are in the cycle. So I really don't think that we're at the ultimate top. I do believe we have some way to go. This is essentially why I think it's important to just track what the OGs are doing. Track what the OGs are doing, because essentially they're the people who have the volume to put tops in, right? But simultaneously they are being countered by institutions coming in. So we have this very, very interesting dynamic where you've got big sellers, but you've also got big buyers. So I mean, this is the thing, right? Back in the cypherpunk days, it was dudes sitting in their basement on their laptop, and essentially had no markets for it. You really needed, $50 and you could buy thousands of coins, or $100, thousands of dollars. Then we move into the next phase, which is kind of the more libertarians. A few funds start coming in 2016, 17. You can start moving around more amounts of money. Now we're moving into the institutional realm. So where people are selling for huge profits, but they're selling to people who can afford to buy things for huge sums. So it's always been this very elegant balance of who's coming in versus who's going out, right? In Bitcoin, it's been this very interesting flow of people. Now, we were talking about our coin days destroyed before, how we had this cycle of selling into strength, relaxing during the consolidation, and then re-kicking back up during the Elon candle. Very similar on the spent output profit ratio. So the way to think about this is just measuring how old the coin was. Now, in general, an old coin is going to be in profit because Bitcoin is up only, right? So older coins are probably going to be in more profit. What the SOPA, or spent output profit ratio, does is it looks at all of the coins that were spent on that particular day, and it says how much profit were they in, right? So if it last moved in 2018, highly likely it's going to have a fairly substantial profit in it. So when you've got a value of 1, it essentially means that the coins that were moving around on that day, they're break even, right? So they're either coins that were bought very recently because there's just no profit in them, or there's no loss in them, or you've got lots of people selling who are in profit and an equal amount of people who are selling at a loss, which is very uncommon. So a value of 1 essentially means that the amount of coins that were moving on that particular day are essentially very young coins, right? Highly probable that they're very young coins. And you can actually see this in our spent output age bands. You can kind of combine this. Let's bring this to here. Hot colors down here are the hot colors are young coins. And the older coins are these purpley colors. So you can see that we've actually got an increasing volume here of this dark yellow, which is this 1 hour to 24 hours. So these are very young coins. You can see that when our spent outputs got to close to 1 or reset, that means that the coins that were moving back here at the bottom of this consolidation were fairly young coins. And you can actually see this, that we're getting an expansion in the young coins, right? So most of the coins that were moving there, it's kind of, think about it as day-to-day chop, right? It's not really relevant. When you've got an uptrend in the SOPA, it means that the coins that are being spent on that particular day are overwhelmingly in profit. The higher it is, the more profit that they're in. Which you can see that this essentially follows price. During the consolidation, we've got a collapse, and we're getting more profit being taken during this rally from the Elon candle. So again, it's really backing up that story that there is still a bit of sell pressure coming in from OGs. Ultimately, what the question comes down to is, how do we compare OG selling pressure to institutional buying pressure? So I still think we're going to get a bit of chop. That's my kind of gut feel. If we look at this is the final one we'll look at. Actually, no, second final. I forgot how comprehensive this dashboard actually is. So this is the entity adjusted ASOL, which is the average spent output lifespan, right? So there's a lot of words in all this, but they're more or less telling a very similar story. What is the average age? If we look at all the coins that were spent, how old are they, right? We don't care about how much volume they were moving. We just care about how old were the coins. Very, very similar pattern. Let's put our price line back on just so we can kind of map it all together. How old were the coins on average? You can see that our age is increasing. So constant baseline, right? Average age of coins moving is 20 days. Starting to get a lifting up of the average as the OGs sell. We're back into a little bit of an uptrend here for the ASOL. So what this is telling me is that older coins are selling into a little bit of the strength, right? So that's kind of what this information is going on. Now, another one that I want to show, this is the final one, is just a very, very big picture, how much profit is in the system. And Glassnode's got this really, really neat tool where they've broken it down into short-term and long-term holders. So let's look at both of these, full history and full history. There we go. So short-term. So the way that they've clustered these is that there's a number of heuristics, but short-term is more or less the trader types, the retail money, people who are moving their coins around on a more regular basis. So this is very similar to the, in fact, it is the unrealized profit and loss metric. So it's looking at how much profit the coins are once they've been clustered into long-term, short-term. So the first thing that I want to really just point out is look how wrecked short-term holders get during the capitulation, right? We're talking about like 1 is just complete decimation, -4 is just getting hammered on their investments. So you can see that we get these very, very deep pullbacks. Let's actually chop that one off. But you can see here that the short term, it's fairly constrained once we got that initial sell-off, but fairly constrained between 0.5, so 50% profit, and 25% losses are fairly common through the bear market. And you can see that the bear market, they're pretty much getting nuked the entire time, right? So the bear market is pretty painful for short-term sellers. They're essentially just getting chopped up, as you would expect, to be honest. And you can also see that short-term holders make roughly 25% profit before they sell, right? They're quite happy with 25% until the very, very tippity top, right? They kind of oscillate around this 25%, peaks, sells off, peaks, sells off, peaks, sells off. And you can see that they lose a lot of money during the pullbacks. This looks like retail behavior, right? Sell too early and then sell at the bottom. Right, sell with small profit, sell at the bottom. So it's kind of those two different classes of traders, of people who are essentially getting wrecked on both fronts. Now, if we compare that to our long-term holder, look how much smoother this is. So you can actually see the very, very different behavior in long-term holders. So they allow, right? They obviously some of them get wrecked at the bottom, but you're going to get this huge long hold, right? And up in this blue zone is essentially the euphoria phase where they're just, they're up over 75%, almost at 100% profit for all this kind of thing. They're quite happy with their 100% profits. And then we get this long, slow decline. And I mean, very, very smooth, very different behavior. And you can see that we've basically just moved into the, this is where I'm kind of confirming here that we are now in the euphoria phase of this bull market, which is fine because you can see that here, I mean, this started in, was it February 27th, 2013 and went to, so just over a year we spent in this, 15 months or so in this particular euphoria zone. Here we're talking about 5th of May, 2017. And we came out, and again, some of this is obviously beyond the peak, but we stay in this euphoria phase. What was it, May 2015, 2017, about a year. So we've got about a year in this phase, and by the looks of things, you've essentially got, I mean, here's our peak here. Let's say 2/3 of it in the bull, 1/3 of it in the bear. 2/3 of it in the bull, maybe half in this instance, 1/3 of it in the bear. So this kind of defines that we've essentially entered into this phase. Now let's take that same logic. We've hit December. So December last year, we entered the euphoria phase, right, in theory, which is essentially breaking the all-time high, more or less, which I actually, if we peg back here, yeah, look at that, all-time high, right? We map this guy across to here. Essentially, when we break the all-time high, it's, old-term holders bought down here. Once we break all-time high, they're essentially in the money for the entire duration of the rally. So what this is saying, if we're talking about, I don't know, let's say 8 months, December, so that's putting us somewhere around maybe October, September kind of time for maybe when we start to approach some kind of top out signal. That's maybe a time frame. It kind of aligns with what a lot of people are saying, that we're kind of talking about December next year. If we follow this metric, maybe it's actually gonna be a little bit sooner than that. But these are all kind of tools that we can use to track whereabouts we are in the grand scheme of things. So just to kind of summarize before we close out here, let's just jump back to our dashboard for completeness. So more or less what we're seeing, there is no doubt that we have institutions coming in. They're buying in size. It's very real. We can see it. exchange balances continue to withdraw, and we're not seeing a huge inflow, right? So the market is not what I would call spooked right now. Miners have clearly been accumulating. We got one big miner that basically sold off and took profits. Good for him. We saw profit taking in pretty much all of our OG whale metrics. So we saw profit taking from the all-time high to 40,000. They stopped their selling in the consolidation, which means that they're pretty much, that is a bullish signal. They don't want to just liquidate. They're not scared. I don't think the market is spooked. But we're also seeing during this rally up to 48,000, we're seeing that sell pressure re-increase, and it's re-increasing fairly significantly. So what that's telling me is that we could have a bit more chop to come. Maybe that's good for altcoins. We'll see. There's a few shaky signs in the macro economy, which will probably have some role to play. There's got to be some event. Maybe we get a crack up boom. Maybe the thing falls over. We just don't know. In terms of the cyclical nature of this thing, there's very few signals telling us we're at the end of the bull market. It's most likely telling us that we've still got some time to go. But it is possible that we get a little bit of chop from here on. So we'll wait and see. But we've certainly transitioned into the euphoria phase. Who knows? Maybe we've got another 6 to 8 months still kind of carrying on from this. October, September, if you look at the long-term hodler chart. But more or less, just be careful. Have just a bit of a idea for risk that could be on the table. Have your signals in play for when you think that we're actually going to kick up and really start moving again. OGs are essentially the ones that are going to be putting in the top for this kind of thing. But with the amount of news that's coming out with institutions, it's equally as likely that we're going to get just continued moves higher. So if I'm going to give my honest probabilities right now, it's a 50-50 as to whether we get chop. And maybe a nice healthy correction, which I wouldn't be opposed to, or that we just keep rallying higher as if supply is no concern, and once we get past 52,000 or whatever it is, and we become a $1 trillion asset class, who knows what doors that open. So it really is a bit of a coin toss at this point in time. I think it relies a lot on the macro economy. Keep an eye on the DXY, the dollar chart. Keep an eye on 10-year and 5-year bond yields in the US. Just to see whether we're going to get some kind of debt squeeze. But ultimately, it sounds like there's stimulus across the board. There's all this macro stuff going on, but there's a lot happening. But it's a bit of a coin toss at this point in time. So thanks for tuning in. I'm really looking forward to spending more time in these metrics. I feel like I'm surrounded by data and charts. There's going to be a lot that comes out of this. I'm really excited to kind of show you guys and walk you through. And what you can see here is the tools are all available. Ultimately, it's just about understanding the interpretation, which is ultimately, I think, why you're here and why I'm here, right? It's all about trying to help each other come to terms with how we use these tools, because so few people know how to do this, right? And it's not because it's necessarily hard, it's just because people haven't spent the time to study it. And that's ultimately the edge that I want to be at least giving you guys as far as I can. But thanks for tuning in, and I'll catch you all in the chat rooms. Cheers.